Okay, hello. This is Dave Tallman. I'm a certified mortgage loan officer here at Mortgage Solutions of Georgia. I am also the owner of Mortgage Solutions of Georgia, and today we're going to have a little webinar on understanding mortgage rates. So let's just get right into it. Okay, introduction to mortgage rates. Mortgage rates refer to the interest rates charged on a loan used to purchase a home. These rates can vary based on several factors, including the lender, the borrower's creditworthiness, market conditions, and the type of mortgage that the applicant is applying for. Typically, mortgage rates can be fixed, which means remaining the same throughout the life of the loan, or adjustable, which means that the payment might fluctuate depending on market conditions. Okay. Mortgage rates play a crucial role in the home buying process and it impacts several factors. Number one, cost of borrowing. So, lower rates reduce the total interest paid on the mortgage loan, making homeownership more affordable. Affordability. Higher rates increase monthly payments, limiting the buying power of the potential applicant and potentially requiring the applicant to purchase a lower priced home. Market dynamics. Rates are influenced by economic factors like inflation and monetary policy. That's very important to note. So every day, the federal government releases different economic reports. Some of which are market movers, meaning that they can be either very good for interest rates or very bad for interest rates. And some economic reports are kind of non starters when it comes to influencing mortgage rates. But the big ones that we look at would be things like inflation, GDP rates, things that have to do with the functioning of our economy. Those are typically the biggest housing movers. Okay. Uh, Lastly, refinancing opportunities. Dropping rates post purchase may allow some homeowners to refinance for some additional monthly savings. Factors influencing mortgage rates. So, as I kind of touched on, mortgage rates are influenced by several key factors. Economic indicators such as employment rates and GDP growth provide insight into the overall health of our economy, which can affect lenders' confidence and borrowing cost. Inflation rates are crucial because higher inflation typically leads to higher interest rates, and lenders seek to maintain their purchasing power. Federal Reserve policies also play a significant role in mortgage rates. As the Fed adjusts the federal funds rate to influence economic activity, changes in this rate often lead to corresponding adjustments in mortgage rates. And lastly, a lender's risk assessment, which evaluates the borrower's creditworthiness and likelihood of default, can impact mortgage rates that are offered. Higher perceived risk usually results in higher mortgage rates to compensate for that potential loss. So let me break that down in layman's terms for you guys. You know, lower the credit score means higher the risk. I mean, there's decades and decades of studies on um, an applicant with a lower score, with a lower down payment, and a higher debt ratio has a significantly higher default rate than an applicant who has great credit scores, very little debt, and a good income and has significant savings in the bank or at least a 2 to 3 month reserve cushion. Okay. So we have examined this for decades and decades. We know lenders know what the risk thresholds are, and if you fall into a bucket where it's perceived that your particular loan application has some of these more risky thresholds, then you can naturally expect that you're going to take a little bit of a higher interest rate to compensate for those risk tolerances. Okay. Types of mortgage rates. So you basically got two kinds. You got a fixed rate mortgage and you got an adjustable rate mortgage. The fixed rate mortgages, these can have terms of 10-year fixed, 15-year fixed, 20, 25, and 30-year fixed rate mortgages. The fixed rate mortgage is going to provide stability and predictable monthly mortgage payments for the duration of the mortgage loan. So, the key benefits to a fixed rate mortgage would be predictable budgeting. I mean, if you know what your monthly mortgage payment is, it's a lot easier for you to budget your total household expenses, and it has long-term savings potential. Okay, an adjustable rate mortgage, or an ARM, as we call them in the industry, have interest rates that will oftentimes be fixed for a short duration of time, and then will start adjusting in accordance to current market conditions. So we commonly will see things like a 3 year arm, or a 5 year arm, or a 7 year arm, or a 10 year arm. Okay. If it's a 5 year arm, what that traditionally will mean is that for the first 5 years of your mortgage loan, you may have a lower interest rate. But after 5 years, you are going to be subject to interest rates either increasing or decreasing, depending upon where the current market sits at when it's time for that ARM loan to start adjusting. Okay. Um, some of the benefits to an ARM loan are lower initial payments, flexibility for potential refinancing or selling, and then possible advantages from decreasing rates. However, it's important to note that borrowers should be very cautious of adjustable rate mortgages. Okay, when the housing market crashed happened in 2008 and 2010. Yes, I'm that old, and I lived and survived through that time period. A lot of that, the cause of that was due to adjustable rate mortgages. So, if you're buying your first home, you should, I feel very strongly, stick to a 30-year fixed rate mortgage, or a 15-year loan, some sort of fixed rate product, just so that you know what to expect mortgage payment month in and month out. Okay. Understanding fixed rate mortgages. So, fixed rate mortgages provide consistent monthly payments and long term stability, making them very popular amongst home buyers. Okay. The interest rate on a fixed rate mortgage remains unchanged. And this helps you budget your household finances, and helps you build a good, strong financial plan for years to come. Okay. I just want to make an important side note here. So, even though you have a fixed rate mortgage, okay, your principal and interest portion of your monthly payment will always remain the same. However, your total monthly payment may go up or down based on possibly increases in your property taxes, or increases in your homeowner's insurance. Okay. So if you have a fixed rate mortgage, your principal and interest portion of that mortgage will always remain the same. However, important to note that your monthly mortgage payment may fluctuate depending on things like taxes and insurance. Okay. A couple of potential drawbacks to a fixed rate mortgage is higher initial rates compared to a potential ARM loan. Maybe a little bit less flexibility when it comes time to refinance if rates do decline. But in summary, um, if you're buying your first home, we strongly encourage a fixed rate mortgage. And I'm recording this at the tail end of 2024. And I will tell you, at this time in the market, there's not a lot of ARM products that are readily available for the consumer to select from, anyways. All right. Understanding adjustable rate mortgages, we call these ARM loans. So these are variable interest rates. The key feature here is that you will have a shorter duration of a fixed rate time period. Generally, that is going to be like a 3 year fixed rate time period, or a 5 year time period where your interest rate is fixed. But then after that time period, your ARM loan can adjust up or down. So your mortgage payment can go up or down. And this is typically based on current market conditions. Okay. Um, okay. How to qualify for the best rates. So that's what you're really here for. Dave, how do I assure that I get the best rate on the mortgage? Okay. I want to really hone in on this, and I want you to understand. Um, After being in the finance industry for over 20 years now, what I can tell you is that the mortgage loan with the lowest rate oftentimes is not the best rate for the applicant. Okay. It is really important that you understand that The particular loan that carries the rock bottom lowest financing rate oftentimes comes with the highest set of closing costs. Okay. Conversely, a higher interest rate would more than likely result in a lower set of closing costs. Okay. So every applicant is unique. Every situation is unique. And what we try to do here at Mortgage Solutions is create a custom mortgage plan that is unique for you, that's going to allow you to gain home ownership, that's going to meet both your short term and long term goals. But in generally speaking, how do I qualify for the best rates? Okay. Number one, your debt ratio is really important. Your debt ratio looks at how much money you make compared to how much money you spend. Okay. So, what we really want to see here is a lower debt ratio. That's going to help you qualify for more of a mortgage, but also assure that you can get yourself into a good mortgage product. Okay. Loan type and loan term is number two. So fixed rate loans offer consistent payments while adjustable rate mortgages fluctuate. Uh, the length of your loan can oftentimes impact your overall mortgage interest rate. So, for example, um, a 30-year fixed rate mortgage is probably going to come with a little bit of a higher interest rate than, say, a 15-year mortgage. And the reason for that is because you're financing over a shorter duration of time. So, there's less risk involved from the lending side of it if you're financing over a shorter duration of time. There's less chance that this particular applicant who's financing on a 15-year loan may experience some credit issues or maybe lose a job during that time frame. So the longer your loan term, the higher your interest rate is generally going to be, and the shorter your loan term, the lower your interest rate is generally going to be. Okay. Shopping around. So, you know, every bank, every credit union, every mortgage lender like us is going to have a slightly varying degree of a different interest rate. Okay. But in generally speaking, we're all kind of going to be lumped in at the same kind of price point. So, what's important for you to know on this is, you can shop around and talk to 100 different banks, and you can always find a lower rate somewhere else. Okay. But the challenge for you in doing so is the time it takes to do that, all of the credit inquiries that occurs. And you don't want to really just call around and say, hey, what's your rate today? Okay. Because there's about 35 different factors that goes into an applicant's particular interest rate that they're going to get on their mortgage loan. Okay. So the better way to do this is to just call around a couple of different mortgage people that have been recommended to you, and have a conversation with them. Ask them some questions, see how they answer. At the end of the day, what's most important here is that you become a homeowner. Okay. Of course, any loan officer wants to make sure that we get you the lowest rate, but I don't want to sacrifice you becoming a homeowner just in exchange for getting you the lowest rate. When the primary objective here is for you to be a homeowner and to gain home ownership. Okay, so just keep that in mind. And when we're talking to different banks and different loan officers, what's most important here is, who do you feel most confident in can get you to the closing table and get you some keys to your home? That's really what's most important, over and above shopping around for the lowest rate. Okay, because again, the lowest rate oftentimes is going to come with the highest set of closing costs, and you may or may not it may or may not be in your particular best interest to spend a bunch of money in closing costs to get a lower interest rate, if maybe you're not going to live in this home for but 2 or 3 years. Well, then it certainly doesn't make sense to spend a bunch of thousands of additional dollars to secure a lower financing rate when you may only live in this home for 3 to 5 years. Okay. So this is where having conversations with your loan officer, and having consultations with them, having you ask them ask you questions. This is how you get a great home loan that meets both your short term and long term goals. Um, Number four, timing the market. So, economic conditions and personal readiness influence the best time to apply for a mortgage. All right. So let me just go off on a little tangent here. Um, Guys, I don't really care what mortgage rates are because it's almost impossible nowadays to time the market. Understand that mortgage financing rates change every single day. On most days, they might change multiple times a day. So, if you're trying to shop around, you talk to a bank on Monday, you talk to another one on Wednesday and one on Friday, they're probably all going to have different rates because the rates have changed from Monday to Wednesday to Friday. So, um, it's really difficult to time the market also in today's market because there's so much economic data that's coming out that's made publicly available that the market shifts around multiple times a day. So don't worry about necessarily timing the market per se. What you need to have is your personal readiness. So I believe that well, I don't believe this, I know this, but you may not know this, so I'm going to tell it to you. Okay. The vast majority of the wealth that is created or the vast majority of net worth that Americans have is derived from the equity that they have within their home. Okay. So, you know, right now, as I'm recording this at the end of 2024, the average rate of home value appreciation in the state of Georgia is going to be around 6%. That's a tremendous amount of equity that one can pick up, and it compounds upon itself year in and year out. Okay. So we're not so much trying to time the market to try to get a better rate, but what we are doing is trying to have some personal readiness so that when the time comes, we've kind of got all of our financial ducks in a row to be able to be approved for a mortgage loan, but not just be approved for a mortgage loan, be approved for a great mortgage loan with a great interest rate as well. Okay. Um, Next one is pre-approval. Guys, if you're thinking about buying a home, you know, the very first thing that you need to do before even speaking to a realtor is you need to get pre-approved, which means you need to talk to a couple different loan officers and figure out who you feel most comfortable with and who you feel like is most competent. Okay. The pre-approval process sets the stage for future success in your home buying adventure. Okay. The pre-approval process allows us to formulate a custom mortgage plan that is unique to you. It allows us to explore your credit score, what you can do, what you can't do, where you are feel comfortable at for monthly mortgage payments. And stemming from that conversation, we create a custom mortgage plan that is unique to you and only to you. Then we can go back to your realtor and we can say, "Hey, we've spoken to Mr. Jones. He wants a mortgage payment of around of X, and so based off of his desire to have a mortgage payment of X, we need to now search for him for properties that are between this price and this price." Okay. This is how we make the time that you spend with your loan officer and more importantly with your realtor, we want that time to be spent very, very efficiently. If you've got a $1,500 a month budget for your mortgage payment, there's no use in showing you four and $500,000 homes. Okay. That's a recipe for disaster and that never really ends well. So the pre-approval process is step number one. It is a critical step because it sets the table for everything else that we do moving down the road to help you get into your home. Okay. And then lastly, improving your financial health. Okay. Boosting your credit score and reducing your debt before applying for a mortgage loan can significantly better your loan terms. Okay. So sometimes what I'll do is I'll have a consultation with a potential applicant and we'll kind of discuss what they've got on their credit score and then we may credit report and then we may make some recommendations. Hey, I want you to pay down this credit card to this much. I want you to pay off this debt. And then let's give it a month and come back to the table. We'll reevaluate at that time. Okay. Um, my job as a loan officer is to put you into the best financial position, again, to guarantee short-term success but long-term success. I oftentimes find myself having a conversation with my applicants. Uh, I don't want to write you a good mortgage. I want to write you a great mortgage. Buying a home for many of us is hard. It's stressful. It's hard. It doesn't have to be, but it can certainly be. And it's regardless if it's hard or not, it's certainly always stressful. Okay, the way that we make this process easier and less stressful as we go into it having a plan and you're ready to execute the plan. Okay. So just consider some of these factors that we've touched on above, because all of these can help you save a lot of money over the life of your loan. Okay. All right, tips for managing your mortgage. Okay. Obviously, the more income that you have coming in, the easier it's going to be to help you pay your mortgage payment. So, one thing that we found, especially this post-COVID era, is that there's a lot of kind of side businesses that you can do from the comfort of your home office or your living room couch. So, number one, you could look for additional income streams. Finding ways to supplement your primary income, such as a part time job or rental income, can help ease the burden of mortgage payments and enhance your financial security. Number two, improving your credit score. A good credit score can lower your mortgage interest rate. It's probably the number one factor that we look at. Having a good score can save you money over a long duration of time, and that adds up to tens of thousands of dollars over the life of your loan. Um, Building an emergency fund. Just a side note on this, guys. So, here at Mortgage Solutions, we talk to our past clients very, very frequently. We call them on their birthday. We talk to them generally once a quarter, and um, buying a home, look, you sit down at the closing table. It's a celebration moment. You did it. You accomplished something. You should be proud of yourself. um, but there's nothing worse than you going through that process, celebrating your win. You're a homeowner, and then something catastrophic happens down the road, and now you're faced with the potential of losing your home due to foreclosure. Maybe somebody lost a job, maybe somebody got sick. It could be any number of reasons. But the point I'm getting at is, um, when we talk to our past clients, and from time to time we have to have some difficult conversations, and we hear from somebody of, hey, Dave, this and this happened, and unfortunately, we're a couple months behind our mortgage payment. We go back as a team and we analyze, well, what happened here, right? I mean, in some cases, there's nothing that could have prevented what happened. Something catastrophic happened, and the applicant themselves couldn't have it. But more times than not, what we find is that people who buy a home and don't have 2 to 3 months of housing related expenses kind of set aside in an emergency fund, these applicants are highly susceptible to having mortgage issues. Okay. So building an emergency fund is critically important. An emergency fund, in my opinion, is essential for unexpected expenses like medical bills or job losses. Um, you should aim to have 3 to 6 months worth of living expenses to maintain a financial cushion and avoid falling behind on payments. This is practical financing 101. You should always look to have an emergency fund, some money tucked away. I don't even care if it's held in cash, but it's got to be, you got to have it. It's got to be tucked away someplace that you don't even see it day in and day out, but it's there if you need it. Okay. And then lastly, seek a professional advice. Okay. Consulting a financial advisor, consulting with your mortgage consultant to help you through some tough times and make good informed decisions is critical to your success, both long term and short term. Okay. All right, so let's review. This presentation on mortgage rates provides an overview of factors and their impact on home buying, starting with an explanation of mortgage rates, um, as interest rates on loans. Okay. Key influencing factors include economic indicators, inflation, and Federal Reserve interest rates, and economic policies, quite frankly. Okay. Remember to distinguish between fixed rate mortgages, which offer fixed rate payments, versus adjustable rate mortgages or ARM loans, which offer a shorter duration of a fixed rate period, but then can fluctuate after that fixed rate period has expired. Okay. Stay proactive, and to qualify for the best rates, you're going to want to look at factors like, trying to get the highest and best credit score that you possibly can. Down payment size is one of the things that we look at. Your income stability is absolutely crucial. Underwriters like stability. They want to see that you've been on your job, that you've got stable income coming in. Okay. Um, Remember to utilize those practical budgeting and refinancing tips. Reach out to your loan officer with any questions that may come up post closing, so that they can help you through the process to make the best decisions. So, hey, I hope that this has been enlightening to you. This information and content has been helpful. My team is always available to you if you have any additional questions regarding interest rates, where we currently sit at, um, any tips that we can provide to help you assure that you get the lowest and best financing rates available. We welcome those conversations. Just feel free to give us a call at our office anytime here at Mortgage Solutions of Georgia. Again, my name is Dave Tallman. I'll be happy to personally schedule a call with you if that's what you would like. And we'll jump on a phone call together. We'll explore some different options for you. But just give us a ring. We're people just like you. We're here to help you. We want to help you. We are not like the typical bank, so there's no need for you to be nervous at all. We want to write you a loan. We want to lend you some money. So just feel free to reach out and touch base with us anytime. Our office number here is 770-924-1111. Thank you.